If you've ever wanted to invest but felt overwhelmed, here's the good part. You don't have to predict the next Apple or sit there reading charts at midnight. There's a simpler path that lets you own the market without guessing winners. Index funds. An index fund is just a basket that mirrors a market index. Buy an S&P 500 index fund and, instantly, you own tiny slices of 500 large U.S. companies, Apple, Microsoft, Amazon, Google, Coca-Cola, the whole crowd. One purchase, broad coverage. You're not betting on a single business, you're buying a little bit of the entire economy. Why does that matter? 3 reasons you can actually feel: diversification, low cost, and long-term results. Diversification first. One stock is concentration. Great when it soars, brutal when it stumbles. An index fund spreads your risk across hundreds of businesses and industries. One company has a bad quarter, it barely moves the needle. New winners show up, the index adds them. Laggards fade, their weight shrinks. You don't have to chase rotation, you ride it. Costs next. Fees are the quiet thieves of compounding. Many actively managed funds charge around 1% a year. That sounds tiny until you run it forward for decades. A 1% drag can erase tens of thousands of dollars you would have kept. Broad index funds often charge near zero. Expense ratios like 0.03% mean $3 a year on $10,000 invested. Fees compound against you, keeping them microscopic compounds for you. And performance. Over long stretches, most pros don't beat the market. That's not a dig, it's what the data says. Index funds aren't trying to be clever. They aim to be the market, take what the market gives, and historically, that's been a solid path to wealth if you give it enough time. Time in the market beats timing the market. So how do you actually use them? Keep it boring, in a good way. Pick a low-cost broad fund as your core, an S&P 500 fund if you want U.S. stocks, or a global fund if you want the world. Automate a monthly contribution. Reinvest dividends so your money buys more of itself. If volatility makes you nervous, add a bond index fund. Set a mix, say 80% stocks, 20% bonds, and rebalance once a year. Done. Let's put numbers on it so it feels real. Say you invest $300 a month. At an 8% average annual return, you were looking at roughly $447,000 after 30 years and about $1.05 million after 40. At 10%, it's about $678,000 after 30 years and roughly $1.9 million after 40. Not guarantees, markets bounce around, but that's the math of steady contributions plus time. Now watch what a 1% fee does. Drop that 8% down to 7% and the same $300 a month becomes about $366,000 after 30 years and $787,000 after 40. That is the cost of just 1%. What about taxes? They matter more than most people think. In the US, 401ks and IRAs let your money grow with tax advantages. In the UK, ISAs do the same. Use the wrapper available to you so more of your return stays invested. Low fees and smart tax sheltering are the 2 levers you control on day one. Okay, but aren't index funds boring? Honestly, yes. And that's the point. Boring is sustainable. If you want a little excitement, keep a small satellite slice for individual stocks you truly understand. Let the index fund be the core meal. The stock picks are the seasoning. Enjoy them. Just don't let seasoning become the whole dinner. There's also the mutual fund question. Index funds can come as mutual funds or ETFs. Both track indexes. The big difference you'll notice is trading mechanics. ETFs trade all day like a stock. Index mutual funds price once per day after the market closes. For most long-term investors, either works. What matters is still cost, tracking accuracy, and whether the fund actually follows a broad, sensible index. Speaking of tracking, check 2 things before you buy: the expense ratio and the index methodology. Expense ratio is the annual fee. Lower is better. Methodology tells you what you're really buying. S&P 500 is clear. Total market means thousands of companies, big to small. Global ex-US means international stocks only. Understand the label and you'll understand the behavior. Another quiet advantage of index funds is tax efficiency. Because they don't trade in and out of positions much, they typically distribute fewer taxable capital gains than active funds. Less turnover, fewer surprises in April. Again, costs and taxes. Control the drags you can control. What about dollar cost averaging versus lump sum? Lump sum wins more often on paper because markets tend to go up over time, but behavior beats theory. If investing a lump sum keeps you up at night, set a simple monthly schedule and stick to it. Consistency is the superpower. The best plan is the one you follow. Now the common objections. Aren't index funds a bubble because everyone buys them? Prices in the index are still set by active buyers and sellers haggling over individual companies. Index funds ride those prices. They don't set them. Leadership shifts, the index shifts with it. Won't I miss the next Amazon? You'll own it as it becomes a leader, without betting your future on a guess. What if this time is different? It always feels different. That is why you set your rules when you calm and follow them when markets are loud. Let's add a simple framework you can act on today. Step 1. Open a brokerage or a tax-advantaged account depending on where you live. Step 2. Choose one broad, low-cost stock index fund as your core, and, if you want, one broad bond index fund. Step 3. Automate a monthly contribution the day after payday so you never see the cash pile up in checking. Step 4. Turn on dividend reinvestment. Step 5. Build a small emergency fund so a car repair doesn't force you to sell at the bottom. Step 6. Review once a year. Rebalance to your target mix. Not daily, not hourly. Once. If you want to go a level deeper, think about home bias. Many investors put everything in their home market because it feels familiar. A US investor might own only the S&P 500. A UK investor might own mainly FTSE names. Consider adding a global index fund so you capture growth wherever it shows up. The world changes. Broad exposure means you don't have to predict where. Risk isn't eliminated. Markets fall. Owning an index fund means accepting market volatility in exchange for market returns. The antidote is preparation and perspective. Invest money you won't need soon. Expect recessions to show up sometimes. And remember that the long-term trend is built from many short-term storms. The biggest enemy of compounding isn't a bad year. It's bailing out at the worst moment. Behavior beats brilliance. Switching strategies, chasing headlines, and trying to time entries and exits usually backfire. Miss just a handful of the best days in the market, and your long-term return can fall dramatically. Create a simple policy: how much you invest, how you allocate, when you rebalance, and follow it. Let boredom work for you. Here's the real takeaway. You don't need to be a market genius to build wealth. You need a simple plan you'll actually follow. Broad diversification, tiny fees, regular contributions. Time. Own the market, keep your costs microscopic, use the tax wrappers you have, and let compounding do its quiet work. Index funds make that possible. Simple, resilient, and for most people, the smartest way to invest.